Hello, everybody. I'm Ken Clark. I'm the editor of Hardware and Building Supply Dealer magazine. Welcome to day one of our 2023 LBM Finance and Development Week series of presentations. We've got fun activities coming up Monday, Tuesday, and Wednesday. We kick off with our traditional State of the Industry webcast. Today's presentation is brought to you by our friends at Epicor. More than 60% of the top pro dealers in North America manage their business with Epicor software. Let me say that again. More than 60% of the top pro dealers in North America manage their business with Epicor software, and we appreciate their support not only today, but throughout the year. And with me today is our special guest, Grant Farnsworth. He's the president of the Farnsworth Group. He's in Denver today. The Farnsworth Group helps companies in the building products and home improvement industry improve their business strategy through custom market research and market intelligence consulting. You might have seen Grant performing many of those duties at the National Hardware Show very recently. He's a well-respected speaker, and we're very happy to have him. Grant, could you say hello to our audience?
Hello, audience. Hello, Ken. It's always good to be with you. Looking forward to some good conversations for today. Thanks as always for having us.
Well, we're thrilled to have you. Is there any opening salvo you'd like to make about the state of the industry? Here are the things we hear about a lot: the labor shortage, industry consolidation, inflation, a panicky consumer. What stands out to you?
You're leaving out material prices, material availability. There's all kinds of doom and gloom headlines I think we are seeing, and we can fall victim to. I think we need to also look at some of the supply and demand fundamentals, particularly the demand side of things, along with the psychological piece that may be getting lost in some of those more negative headlines. Not to say, Ken, that we don't have headwinds for the next 12, 18, 24 months, but there are some fundamentals that would support that there is opportunity even in this year.
A good place to start a state of the industry would be looking at the annual housing starts figures. Let's call them up now. We've got the January numbers just came out. They showed that we're at a pace of 1.58 million. That's down 6% from December. But here's the chart showing annual starts. 2022 seems to be the first downturn since 2009, actually. This chart only goes to 2012. But according to the NAHB, the National Association of Home Builders forecast, which was delivered just at the International Builder Show very recently, we're looking at about a 25% decline in 2023, followed by a little bit of a rebound in 2024. These are some of the headwinds you might have referred to earlier, Grant.
Yep.
What are your thoughts when you see this chart?
Not surprising when you look at what a lot of the inputs going into, particularly the production side of new housing starts. So material costs obviously are still high in many areas, bouncing around in others. Maybe they finally started coming down in some, but that remains a challenge. The labor costs remain a challenge. The land prices and land availability remains a challenge. So certainly a lot of headwinds on the builder side as you think about their cost and ability to hit margins from the production side. And then on the consumer side, the would-be home buyers, there are real financial implications to these increasing rates, right? So a mortgage today versus this time last year is anywhere from, call it $500 to $800 more per month for that average median priced home. So there are real financial implications that are kicking a lot of would-be buyers to the sidelines. That said, there are also a lot of folks that are now staying put in their homes almost due to that lock-in effect. I've got a sub 3% mortgage. I'm not going, even if there was a house available, which there isn't, I'm not going to leave this sub 3% mortgage. So not surprising to see the declines in housing starts. It coincides. You mentioned, we've seen an increase in housing starts really since 2009. At that same time, we've been seeing a decline in 30-year mortgages since 2009. So this is the first time in a long time where rates have reversed course over the past 12, 13 years. And we're seeing the consumer psychologically react to that and say, I'm going to hold off until those rates subside, until the price point of the home comes down. So not surprised to see it. Was surprised to see some of the forecasts from NHB with multifamily being down 28% in 2023. That said, we've also seen some forecasts that aren't as bleak. We look at Epicor ISI, they're down only 13% over 2022 for single family starts. No matter who you look at, though, Ken, I think the consensus is we are going to be down. We're going to be down substantially for 2023.
I got to give a shout out to David Deese, the chief economist at the NAHB. These are the numbers that he presented at the Builder Show. One positive he mentioned was remodeling. Remodeling is going to be strong, he believes. And you mentioned psychology. He also mentioned that the psychology of seeing interest rates at 7% might actually help the buyer in 2023 and 2024 when they dip to
correct
relatively low.
Yep.
In that case, 6 to 5%.
And we've seen that already, right, Ken? So in those few weeks where we saw mortgage rates come down to around 6 and hover, all of a sudden mortgage applications were up, and the minute it got back up to 6.5%, 7%, mortgage applications were down. So I think we're seeing already some glimpses that the consumer is reacting pretty quickly, subject to those rates. And by the end of 23 into early 24, we expect those rates really to settle out around kind of that 6% mark, which historically is still very, very low. We've just been spoiled these last several years with just unprecedented mortgage rates. So I think it's that reset for the consumer. Once they see some stability and we can hover around, call it 5.5, 6, maybe just over 6, reset those expectations of the reality is I'm never going to get a 2.5% mortgage again. 6% is where it's at. I'm comfortable with it. Great. I want to go buy a house. That intent is still there, Ken. I think they just need to see stability and comfort in where things are going to be for a longer period of time rather than just, a week or two.
Also in recent days, we've heard from the chief executives and the executive teams at Home Depot and Lowe's. This is, of course, the LBM Finance and Development Week, but those guys talked a lot about lumber. Yep. They sell a lot of lumber. We're looking here at a chart showing the Home Depot and Lowe's sales, and these are in billions of dollars, Grant, billions of dollars. And the one fascinating fact that we've pointed to in the past couple of weeks is the gap between 157.4 billion in sales in 2022 compared to 110.2. That's $47.2 billion of new business that has kind of dropped into the home improvement market, and that's got to have some repercussions.
Yeah, we grew a lot in a short period of time. You're not going to sustain that growth. I don't think that's an insight that no one's thought of before. But what I think is really fascinating, particularly when we look at the home improvement remodeling side of our world, is that we still expect to hold that new bar. Maybe even see a little bit of growth on the remodeling side. NHB forecasts roughly 5% up in 2023 for remodeling. HERE, the Home Improvement Research Institute, suggests right around that 5-6% product sale growth in 23. Harvard is right around there with kind of 6% growth mid-year and flat towards the end of the year. So when we look at that remodel home improvement side of the world, I think, again, that there's some fundamentals that would suggest we can maintain the insane growth we saw over the last few years. Our median age of the home in America now is over 40 years old, right? We are severely underbuilt. There's less than 3 months of inventory of existing homes. People are staying put in their home, while at the same time, for the past 3 years, they've gained anywhere from nationally 30 to 40% increase in their home value. So that's a lot of equity gain. Even if we give back 10% this year, you're still going to have a 20, 30% gain of equity over the past 3 to 4 years. That equity is key to being able to do some larger home improvement renovations, remodels. Certainly the maintenance side always fares better in down markets, and even more so when we've got an aging housing stock. So I think the growth has been remarkable. It's not sustainable, but what is, I think the positive is that we can at least hold that level of spend for home improvement this year and going into next.
What you say there reflects some of the ideas behind what I call Marvin Ellison's big 3 drivers. Marvin Ellison, the CEO of Lowe's, pointed to, just as you said, disposable personal income is up. Home price appreciation, which you mentioned, he used the figure of $330,000 is the average equity that the homeowner has. Very high number. And also the age of housing stock. He pointed in the Lowe's call just last week, Lowe's executives described 50% of U.S. homes are over 41 years old. And that's the oldest housing stock since World War II.
You got it.
Those are all good factors for spending and remodeling.
Absolutely. Yeah. And I think also take into account that a lot of DIY activity has happened over the past 2-3 years, and some of that's been exhausted, right? So homeowners now may be tapped out of their capabilities, and they've got bigger projects they want to bring on board because they've made the decision, well, I'm not going to move, right? I don't have any housing supplies, existing housing supplies below 3 months, so I really don't have many choices out there. And I also don't want to give up, as we talked about before, I don't want to give up that sub 3% mortgage. So I'm going to stay put. I've got a lot of equity. I can't do the work myself anymore. But the intent is still high to do a big project. So when we look at our Farnsworth Group contractor index we put out each quarter, it's amongst existing home residential contractors. Nearly a third saw their project sizes increase over the past 3 months. So I think this speaks to the fact that some of the DIY small project is going to be done, and now they're going to be leaning on contractors to be doing the work. A lot of DIFM stuff happening now and happening kind of in the future, leveraging that equity to do it. So potentially larger project sizes, because I've already done some of the small stuff, painting or maybe replacing some fixtures, et cetera.
I promised I'd talk about a little bit of lumber prices based on the Home Depot and Lowe's reports, but as you see in the chart on the right here, in the rivalry watch where comp store sales dip below 0% for both companies. Both companies point to what they say is accelerating commodity pricing. In other words, lumber prices went up. The interesting statistic from Ted Decker, CEO of Home Depot, is that framing lumber is $420 per 1,000 board feet on average in the fourth quarter this year, compared to a year ago when it was $886 per 1,000 board feet on average. You translate that into what you see in the aisles. 2x4 stud, one of their most popular sellers in the most recent fourth quarter, was selling on average at $3.40. A year ago, it was over $5. So these commodity prices, lumber prices, really weighed on the sales of not only Home Depot and Lowe's, but also Builders First Source in the fourth quarter. Yep. And when analysts push to find out what they think lumber is going to do, there's really no answer. Nobody really knows what's going to happen with lumber prices, but it is a headwind, it seems.
It is, and there's a lot of people out there that are much smarter than I when it comes to some of these commodity prices. We're tracking them similar to you, Ken, and see some of them bouncing around. While it may hurt some of the retail sales and lumberyard sales from a top line standpoint, some of those inputs coming down are going to be critical to revigorating new housing starts. So lumber coming down, I think, is one of those inputs, but we've still got metals that are going up. So just as one thing comes down, we see something else increase. We need to have some kind of across the board, again, at least stabilization, hopefully decline, so that we can start building affordable homes, which we are so deficient of in this country.
And construction costs are part of your repertoire, are they not? You have a survey on that topic?
We do. On a monthly basis, the Farnsworth Group, along with the Home Improvement Research Institute, is surveying both homeowners and contractors to understand a lot of behaviors and sentiments on project activity. And the top challenge amongst homeowners, the number one challenge amongst homeowners, is material and project cost, as far as reasons for postponement, reasons for stoppage in the work, just overall challenges that they face when trying to conduct a home improvement, repair, or remodel project. Number one and number two challenges amongst pros continue to be availability, as well as pricing and budget of materials. Those two have swapped in recent months, where price typically is now edging out availability. But those two have been running 1 and 2 consistently, with a distant third, fourth, fifth place. So contractors and homeowners alike are feeling the pressures of material pricing. Over 70% of pros said that last month they experienced their material prices going up. So this is a real concern. This is a real challenge. At our firm, at the Farnsworth Group, we've kind of coined the term that price is the new availability for 2023. And we certainly see that playing out, maybe with the leading indicator of homeowner, and then pushing that down to the remodeler, the home builder.
And in our survey of our readers, we asked what the top challenges were for their business, the number one challenge. And in the most recent survey, staffing shortages took the top spot ahead of what was last year's number one, the product procurement and the supply chain issues. We saw at the Builder Show efforts to recruit high schoolers, efforts to get people involved in the industry. What have you seen on this topic?
It's remained. I mean, we've been talking about labor shortages now for many, many years, and it hasn't gone away. We haven't seen it yet get better from a lot of those initiatives. Believe that it will, but that may be a slow burn. There were over 400,000 construction industry job openings in December, according to Associated Builders and Contractors. We've regularly been setting records in recent months and over the past year for the number of job openings in our industry. So we are still severely deficient in warm bodies for the trades. Labor participation is not coming up the way that many of us expected coming out of the pandemic. We lost a lot of folks participating in the labor pool during the height of the pandemic, and we haven't seen a return of all of those bodies. And that has caused just added strain, not just for our industry, Ken, but really across all industries, whether it's hospitality, tech, healthcare, et cetera. So it's a challenge not just for the construction space. It's a challenge for all industries. The solution that we've seen have more of an impact sooner has been innovation. So a lot of those things that manufacturers can do to make easier to install products, quicker to install products, requires one laborer instead of two, requires less skilled labor. The skilled labor piece is still where we see the biggest challenges. It may get worse before it gets better with the Inflation Reduction Act and some of the incentives for more technology-oriented products and projects, right? Think HVAC, think electrical. So, we hate to be kind of, doom and gloom on the labor front, but if we expect all of a sudden an influx of labor to solve this problem in the next year, we just don't see how that's possible.
And we can't really talk about a state of the industry without touching on the topic of consolidation. We at hbsdealer.com keep tracking the acquisition stories that are happening throughout the year. Depending on who you talk to, there may be anywhere from 70 big deals in 2022 to 85 based on the recent Web Analytics Deals Report, which is sponsored by Epicor. They counted 82 acquisitions in 2022. Our own HBS Dealer Acquisition Tracker counted 75 deals. That's up from about 70 in 2021. And when you talk to the big players in this area, Kodiak, US LBM, Nation's Best Holdings, Builders First Source, they don't seem like they want to let the economy get in the way with a great fit. So I anticipate the march to continue. It's still a very fragmented industry. And so do you have any thoughts on the consolidation and how that might play out?
Yeah, we agree with you, Ken, and see this continuing forward. Not only as some of the independents maybe age out, but also some additional challenges they face. We have yet to talk about some of the behaviors that we see for the state of the industry when we think about kind of purchasing behaviors, shopping behaviors, information and research behaviors, and online digital is a massive component of that. It is not going away. Contractors, we see continue to spend online. In fact, the larger the firm, the more they're spending online. Homeowners, same thing. We continue to see their spend online remain stable coming out of the height of the pandemic. The younger the generation, the more they're spending online. All customers, pro and DIY, are researching and looking for information online. So as some of those logistical requirements are now needed to meet the customer demand, some of those independents are having a hard time figuring out how to get there. It requires capital investment. So I think with a lot of this consolidation, you're seeing a roll-up of funds and that capital needed to be able to compete in an increasingly digital world, which is the expectation of customers left and right. So some headwinds for those independents beyond just aging out, which consolidation may be able to solve.
It's an excellent topic about comparing an independent with a publicly funded national player who might have the investment capability
Right.
in its digital and technology programs. And we've reported about Builders First Source and their efforts to be a digital company, investing a lot of resources in that area. But can technology be seen as an advantage for a smaller player? As the technology advances and the technology becomes more important in this business, which I think we both think it will,
Yeah.
that level the playing field, or does that create a bigger gulf between guys who can put millions into it?
No, I mean, I think if you could figure it out as an independent, if you could figure out that technology piece and how it plays a role, not only for your business, but more importantly for your customer, I think that's an absolute advantage because you can still maintain that service element. That's always been an advantage of the independent, always been an advantage of the dealer. But now if you can layer on those technology kind of demands that the customer has, I think you're in a real good sweet spot. But the challenge is not only just the financial piece of it, but just the technical understanding of it as well for some of those independents. But no, Ken, I think those that are figuring it out are seeing wild success with their business.
Well said. You're watching the 2023 LBM Finance and Development Week State of the Industry Report with Grant Farnsworth. Grant, do you have any final thoughts on something we didn't talk about?
Final thoughts. I think the one thing we haven't talked about as far as what this year may look like is reminding dealers that this is going to be a year of competition. We've got to get back into a competitive mindset. Think about your business in 2017, 18, 19. Maybe don't use 20, 21, 22 as the bar. And you're going to have to compete. You're going to have to fight for share. You're going to have to fight to keep it. There is opportunity in this market. We at the Farnsworth Group see that opportunity in existing home and the pro market. Mobility rates were creeping up to over 13 years in the home for a homeowner prior to the pandemic. They dropped a little bit, but we expect those to come back. So think about that existing home market, what the customer is looking for there, what the contractor is looking for there. We believe equity is going to remain strong. That's going to be a funding vehicle for a lot of those existing home opportunities. We've got that average age of the home now over 40 years old. We talked about that. So there's a lot of upside in the existing home market here in the US, while at the same time, the intent amongst homeowners to do work remains strong. But because of those price pressures, you will see some trade-offs. So how are you positioned from a merchandising standpoint, from a price strategy standpoint, to give them some options? 17% of homeowners purchased less than they had planned last month for their project. 15% purchased a cheaper brand or product because of that need to make some concessions around budget. And we're seeing similar things amongst the pro. 28% of pros last month purchased a cheaper brand or a cheaper product. So there are opportunities. There are going to be price pressures. So make sure you compete and plan for them throughout this year.
Well, Grant Farnsworth, the president of the Farnsworth Group, thank you very much for your thoughts and joining us on our State of the Industry Report. I want to thank again our sponsor, Epicor. Epicor, as you know, has more than 60% of the top pro dealers in North America managing their business with Epicor software. We're going to include our emails for our audience to reach out to us if they have any further questions. We'll be happy to answer those, and please keep those coming. So once again, Grant, thank you. And to our audience, thanks very much for watching.
Thanks, Ken.